It has now been decided to reduce the cash reserve ratio, that is, to reduce the CRR of all banks to 4%.
The Reserve Bank of India has decided to reduce the cash reserve ratio or CRR by 0.5 percentage points, bringing it down to 4%. This move is designed to inject approximately 1.16 lakh crore rupees into India's banking system. Some of you may be wondering what exactly is CRR and how does it work? Stay with us as we break it down. As the name suggests, cash reserve ratio is the percentage of a bank's total deposits that must be maintained as reserves with the RBI. Those reserves are held in cash and are not available for lending or investment. By adjusting the CRR, the RBI can influence the amount of funds banks have available to lend, impacting the overall money supply in the economy. The lower the CRR, the higher the amount of funds banks can lend and vice versa. That's why when RBI Governor Shaktikanta Das announced the CRR cut decision on December 6th, he explained why the central bank was doing this and its impact on liquidity in the banking system.
Now, even as liquidity in the banking system remains adequate, system liquidity may tighten in the coming months due to tax outflows, increase in currency in circulation, and volatility in capital flows. To ease the potential liquidity stress, it has now been decided to reduce the cash reserve ratio, that is, to reduce the CRR of all banks to 4% of net demand and time liabilities, that is NDTL. And this will be done in two equal tranches of 25 basis points each, with effect from the fortnight beginning December 14th and December 28th. This will restore the CRR to 4% of NDTL, which was in fact the prevailing rate before commencement of the policy tightening cycle in April 2022. The reduction in CRR is consistent with the neutral policy stance and would increase primary liquidity of about rupees 1.16 lakh crore, that is 1,16,000 crore to the banking system.
Just to reiterate the impact of the CRR cut, it's expected to provide banks with an extra 1.16 lakh crore rupees. But what does more liquidity in the banking system, or simply put, more funds for banks, mean for us? It means banks can now offer more loans to businesses and retail customers. They can also offer cheaper loans to attract borrowers. This could lead to more investment and consumption, boosting economic growth. The RBI's decision to reduce the cash reserve ratio comes at a time when the Indian economy has faced challenges. India's GDP growth slowed to a near two-year low in the second quarter, and the economy could certainly use a helping hand in terms of monetary policy. What do you think of the RBI's decision? Do you think it's enough to tackle India's growth challenges?